All right, we'll give people another minute or so to get settled in. While we're waiting, you notice that there's a disclaimer at the bottom of the screen. We're lawyers, so it has to be done. And I'll just summarize it for you here. Nothing on this webinar constitutes legal advice, and nothing discussed is protected by attorney-client privilege. So if you have specific questions with confidential information, go ahead and shoot us an email or give us a call, and we'll put up this disclaimer once again at the end. It looks like we have a good amount of people logged in now, so we can go ahead and get started. Yeah. Okay, my name is Rebecca Spence. I'm an associate attorney for the Rodman Law Group. And this webinar is put on by the Rodman Law Group, and we're a Denver-based law firm with a global reach. We are a corporate and regulatory focused firm, and our main practice areas are cannabis, hemp, distributed ledger technology, and litigation. We also have strong trust in estates, fintech, and IP practices. So today we're hosting this webinar to discuss the general landscape of cryptocurrency and decentralized finance, or DeFi. On this panel this evening, I'm really excited. We have an American lawyer, a Canadian lawyer who practices in Thailand, and a financial analyst turned serial entrepreneur. So we're hoping to provide a really unique view on this subject. In addition to a general state of the industry overview, we will discuss a few specific issues regarding the impact of both crypto and DeFi on international trade, and we might even drift a little bit into the case law space. We won't bore you too much with that part, and we'll also be taking questions from you, the audience. So tonight I will give a brief introduction of the three panelists, but then let them introduce themselves. First, we have Dave Rodman. He's the founder and managing partner of the Rodman Law Group. Dave has represented clients in the cannabis and hemp industries for his entire professional career, and he has served as legal counsel to a number of blockchain and cryptocurrency projects, including several ICOs. Next, we have Dr. Jason Corbett, founder and managing partner of Silk Legal, a Bangkok-based law firm that specializes in business law as well as fintech and blockchain regulations. Jason is one of the most experienced and respected attorneys in the blockchain space in Asia and has served as counsel for numerous ICOs, and other blockchain projects. And lastly, we have Ben Lakoff, who's a CFA, entrepreneur, and investor, currently working on projects involving hackathons, digital asset investments, and education about distributed ledger technology. Ben also conducted an ICO for the Intelligent Trading Foundation in 2017. And so we'll turn it over to Dave and start off with a simple question. Can you just give us a very short summary of your background, and specifically in relation to the world of crypto and DeFi?
So starting out with a softball, I like it. First, I just want to say thank you to Rebecca for the time that she took to put into this, and thank you to my co-panelists for taking the time out of their day to mesh our schedules together. We're on opposite ends of the planet, so thanks guys. So yeah, I'm the founder and managing partner of the Rodman Law Group. Got my start in cannabis and hemp law, but I was originally trained as a securities lawyer, and so practicing the cannabis space, I actually got to use that very, very quickly in my career. But what really got me into the whole distributed ledger technology world was actually Mr. Ben Lakoff. He called me one night and told me what he was what he was doing and what the market was like, and I was immediately captivated he was in Thailand at the time, and so I would work till like 2 in the morning, and then from 2 to 4 in the morning, I would be frantically Googling and researching and trying to figure out what the stuff was, and constantly pestering him, which it was actually good timing because 3 in the morning was like lunchtime, so he was always able to take my calls. That's how I also met Jason. And since then, I am by far most excited about the practicing in crypto and in DeFi, and both from a legal standpoint, like a wonky standpoint, but also from a personal standpoint, I follow these things religiously now, and I think they're fascinating and have huge potential. So that's me, and I'll turn it over to whoever is next, Rebecca.
Awesome, thanks, Dave. And it looks like your screen may still be shared. Do you mind just clicking out of that? And then, awesome, thank you. We'll move on to Dr. Corbett.
Well, hi, Rebecca. Thanks for the invite to this webinar. My background basically is around fintech, essentially. So about 5.5 years ago, when I started my practice, we started doing a lot of interesting things in fintech. It kind of came out of a need to have access to capital for small businesses and startups. So we got into things around kind of crowdfunding, different type of mechanisms to basically kind of provide capital for companies. And then 3.5 years ago or so, when the crypto side of things and ICOs became more prevalent, it kind of really perked interest, and we started doing a lot of work in the space. I've worked with about just under 40 different companies over the last 3 years, a variety of things, whether from ICOs, security offerings, DeFi platforms, wallets, exchanges, and everything kind of in between. So we have kind of an interesting kind of experience around all of it. And the market is changing, but it's interesting at all times. It's always a lot of development and things move very fast within the industry. So it's a bit of an interesting place.
Awesome, thank you. We'll move on to Ben.
Thank you, Rebecca. Yeah, so you gave a pretty good background. So my background's in finance. I've always been in investments, and then originally got into crypto more from an investment standpoint, and then started more trading. So was part of a company that did an ICO in 2017, where Dave was involved. And then now I'm actually involved with a company based out of Israel that is doing more of MarTech, but it could be considered DeFi as well. So
Awesome.
Enamored with the space as well.
Ben, for those of us who don't necessarily know the jargon, can you explain what MarTech is?
Yeah, marketing technology. So disrupting things within the marketing world.
Awesome. Well, we're so excited to have all of you. Thanks for joining us. We'll just start by talking about the cryptocurrency space today. What does it look like compared to the last couple of years? Not everybody at once.
Jason, you want to start us off with that one?
2017, early 2018. It was a lot of craziness, essentially. I think one of the key points I remember was going to Consensus in 2018, which is the largest kind of crypto conference in the world, and it was absolute pandemonium. There was a lot of buzz in the air, lots of stuff was happening. During that time, Bitcoin was basically taking kind of a massive fall, coming off its kind of peaks in kind of December, January, 5 months before, but there was still a lot of kind of craziness going on within the marketplace. After that, it's definitely kind of cooled, where we kind of basically saw it go into a bear market, and it's starting to kind of rally again. So it's ups and downs, big swings, and it's interesting in that way. But what we'll kind of see in the background is there's a lot of people kind of getting into it back in the day that were, kind of smaller entrepreneurs, guys looking for making lots of cash, and a lot of people did make a lot of money. whether it be from Bitcoin, Ethereum, different ICOs, kind of skyrocketing values up and down. So there's a lot of people did do very well, and a lot of people did gotten a bit late and kind of lost as well. So it's kind of both sides of the equation. But we're seeing now is moving to more of an institutional play, using the underlying technology to actually fix and do real world problems, creating new types of platforms that haven't been able to be built without using kind of cryptography technology, such as kind of DeFi and the way the smart contracts work. So it's taken a lot of time for it to mature and get to a point where there's actually a viable product in the market. And we're kind of seeing that continue on, and new stuff is coming out, which is even more interesting, like kind of every month.
Awesome. Well, the traditional markets, and this might be a question for Ben or whoever wants to jump in here, but the traditional markets have really taken a huge hit and have started to make a steep recovery. How has this impacted crypto markets?
Yeah, well, I mean, the crypto markets are a highly speculative, volatile asset class. So traditional markets encompasses a lot of different markets, right? So this COVID-19 has been a shock to the system, and crypto was not immune from that. So I think one of the biggest realizations was, a lot of people who follow the crypto markets were always thinking that it's an uncorrelated asset class. It's immune to these shocks, and in fact, it might perform well in this sort of environment, because it is an uncorrelated alternative asset, similar to gold or something like that. So I think there was a lot of surprise when the world kind of saw that both this uncorrelated asset class of crypto and traditional markets both went down heavily. And there are a number of different reasons for that. But I'd say it was a healthy dose of reality for the crypto markets that, although the markets have matured quite a bit over the past 5 years, in the past 2 years, greatly. And there seems to be a little bit more of a hype cycle. It's, we're not immune to, we being the crypto markets are not immune to more global shocks as well as we thought.
Yeah, I mean, just to jump in on that, like, it seems like one of the core narratives of the, at least the Bitcoin argument, is the store of value, uncorrelated asset, and this is the first real challenge to it. And I think that needs to be recognized for what it is, that it could be a permanent challenge to this. But at the same time, there's a part of me that thinks that it will become more truly uncorrelated as it progresses and gets larger. And at the moment, the majority of at least when it fell as far as it did on the same day that the S&P fell, my thought there is that was people who had real investments in other things that they needed to cover their margin accounts on, and they were selling whatever they could to keep their main investment portfolio from taking a hit. And so yes, it was being treated in the crash as a speculative asset. But look, gold went down ridiculously the same day. I'm not saying I'm convinced either way. I lean towards it being its first experience with a bear market, a real bear market, like a systemic bear market, not just a crypto bear market. And we will see it become uncorrelated and fulfill that narrative. But I have to admit that it might not.
It might not. Yeah, I mean, it's a new frontier for it, right? So we will see. But I agree.
So awesome, thank you. What are the implications of halving? And can any of you just quickly define what that is for those who are maybe unfamiliar?
Sure, I can take it. I mean, the halving is
Happening.
every 4 years, the block rewards are cut in half. So effectively, the new supply of Bitcoin that's coming online is cut in half. So the theory here is that there's less new Bitcoins in circulation. So if demand is constant, then price should go up.
So
In
that,
simple terms.
sorry.
That's kind of an interesting segue. Maybe it's a stretch of a segue, Ben, but talking about supply and demand specifically, with QE infinity, how do you guys see that play into the value of the crypto markets in general? I mean, I have my own opinions, obviously, but I'm definitely curious as to what Jason and Ben have to say about that, especially Jason, actually, because maybe being in America, QE infinity is too much on my mind, but I'd love to get your thoughts on the general inflation component.
I think it's really kind of difficult to analyze it at the moment because the markets are in so much flux. There's so many different things happening at the same time. It's trying to correlate anything to to price of Bitcoin, to the halving, to different kind of things that are happening within the marketplace. I think it's kind of difficult. I do see kind of Bitcoin as kind of a long-term store of value. It's kind of at its current kind of frameworks, but things like this happening, I think it is a bit of a a pump, if you want to call it, with investors wanting to get in before it. Is it going to be sustained after they do have the halving? I don't know. My personal kind of thoughts is probably not. We'll probably see another retraction. That's just my kind of personal thoughts of what's going to happen, kind of people I'm talking to within the industry. It's one of these things that just kind of, the price of kind of crypto is all over the place. It does have these kind of extremely kind of volatile swings, and it's because of that, it's maybe not kind of the best investment vehicle there is compared to other kind of commodities and things like gold. But at the same time, we've seen stuff we never thought we'd see in our lifetime, such as negative oil prices. Who would even think that 3 months ago? Just a totally foreign, alien idea. So that's my thoughts on that. Sorry.
I mean, with QE infinity, it's essentially the perfect storm for a Bitcoin bull case, right? It's like Bitcoin is anti that. So it was created because quantitative QE was released, and I mean, this is literally the perfect storm that should give this thing value and utility as a store of value. So, but it's just a matter of time, right? So I continue to be long-term bullish on it, but I'm biased.
Dave, does that answer your question, your curiosity about the subject? Awesome. Thank you. So next question, I was wondering, could cryptocurrencies help emerging economies to overcome inflation and weak financial institutions? We could always dig into Bitcoin as an example, solid place to start. Anyone want to jump at this one?
I mean, I think this might be more of a Ben question with his finance background. My thought, though, just quickly, my 2 cents is the answer is yes, and I'll leave Ben to.
Yeah, could they help with these emerging economies and their less than trustworthy financial setups? Yes, is definitely the answer. I mean, so going back to supply and demand, it's if there is an unlimited supply of money and you're not the reserve currency of the world, then typically you have very dire effects on that economy, like Project Zimbabwe or Germany, sort of thing, back after World War I, rather. But so yes, it does offer an option that, you know, the code dictates the supply of the money supply, and you can't tamper with it. So it's a much better alternative than having some crooked financial system where you just kind of inflate or deflate the currency supply as you wish, right?
Right. So can you expand at all on the how Bitcoin supply is monitored and replenished a little bit? Any of you? Jason, I might have cut you off as well, so feel free to jump in.
As basically as far as supply, it's a ongoing supply basically when miners keep on generating new coins, and as part of the kind of the halvening, you know, that does make a kind of a direct effect to the supply, which should have an effect to price, which is kind of the thoughts around it. You look at other types of cryptocurrencies as well. They produce at kind of different rates, or they might be probably get into things like stable coins afterwards, which would be, you know, better for things like in a developing economy, because you're not going to have the wild swings that crypto does have in the volatility, where it's more kind of price based and kind of locked down to what a basket of goods is, or a dollar, or whatever kind of national currency you're using. You're saying that there is still kind of inflationary measures because it is always backed out to something, whether it be a Thai baht, a US dollar, a euro, whatever it is. And there's always kind of the exchange rate differences and FX differences which need to be taken into account. But we really haven't seen anybody, you know, in kind of developing markets denominating, you know, prices in Bitcoin or something else. It's always in a base currency. So you need to kind of have that kind of framework and stability in place to actually have that within developing markets.
So I've heard a lot about the price prediction model, stock to flow, and know that it became pretty popular last year. Can any of you talk a little bit about what that is and what it kind of tries to describe?
Ben, you want to take that, or you want me to go for it?
Fire away, man.
So stock to flow, I'll do my best. You're gonna have to correct me if I messed anything up here, man. You're the economical whiz, economist in the group. So stock to flow is a valuation method that was created by an anonymous Twitter user named Plan B, who appears for all intents and purposes to be a big time institutional trader, but his identity has been kept a secret, but basically uses a model of that is used to value gold and other precious materials. So it's the idea of how many years it would take for you to double the supply of all available X, you know, whether that's gold, silver, or Bitcoin, and then it's expressed as a number. So I think gold is, I think it's something like 62. It's 62 years for enough mining to be done to double our current supply, and then before the halving, Bitcoin was at like 27 or 25. After the halving, it jumps to 58, I think, or 52, somewhere in there. So almost double. And so the idea being that you can, and he's plotted this both for gold, which is a standard metric actually, and then he's plotted it for Bitcoin, and it actually corresponds with all the previous halvings in a sort of a jagged up and to the right pattern. So the idea is that, well, you know, it's like any kind of technical analysis. You're correlating something that's happened in the past, which, you know, we can argue all day about that, but it does seem to follow pretty accurately the ups and the large ups and small downs all around the halvings that have happened so far, and they happen every 4 years. And if you follow it out, it predicts something like $228,000 Bitcoin, I think, by the next halving, something along that line. So it's, I think what's more interesting is the stock to flow X analysis that he just came out with recently, which plots Bitcoin, silver, gold, and platinum all in the same graph, and they all actually line up. It's pretty cool to see. If you're a general bull, it's cool to see something kind of that is real like that. or looks real.
Definitely not confirmation bias at all, but I'm sure.
Right.
Dave, you crushed it. No, that's exactly what it is. I mean, it's the amount of scarcity for these assets, which are typically like gold or can be used for Bitcoin. The one thing I'll add there is that it's exactly like you said. You know, you plot this up against this or that, and it tracks, and it's on par to be at $100 billion million before we know it. And the problem is, like we talked about in the very beginning, is this crypto market is evolving and maturing so much every year that, like, okay, so 4 years ago there was another happening. Okay, how many of us were like trading Bitcoin 4 years ago? How many of these other people? What was the liquidity? How many of the major exchanges that exist now were online 4 years ago? So the landscape is changing quite a bit. And that's not to say that this pattern won't repeat itself, but this entire industry, this entire market is evolving quite rapidly as well.
That's a good point. We see the same thing in cannabis. You can't compare 2 years ago to now. You just can't. Everything has changed so quickly. In cannabis, it's, you know, from a regulatory standpoint, you know, A doesn't compute to B, but I guess here it's, you know, adoption. You just, we can't connect the tech to the, you know, to the tech and the adoption that was 2 or 3 years ago. That's an interesting point.
Okay, so this is a question for the lawyers in the group. The SEC has seemed to be taking a lot more actions against a number of companies in relation to ICOs. So a lot more people are more familiar with the Howey test. Can you just explain what this is and how it affects ICOs? And Ben, feel free to jump in if you know some stuff about this.
I'll start because I'm the American lawyer, so I kind of have to, but then I'll let the Grandmaster jump in after me. So the Howey test is basically the Supreme Court's test. It's called the Howey test because it was named after a case that it was settled in 1951 or 52. And it has been modified slightly over the years, but it's still referred to as the Howey test. And the basic thrust of it is, what's a security if it's not like full? If it doesn't say it's a security, like right on the face of it, how do you determine if it's a security? And so it's a simple 3 or 4 factor test, depending on how you define the factors. But it's an investment of money into a common enterprise in which the profits are to be derived solely or mostly by the efforts of others. So if you apply that kind of wonky definition to the real world, IBM stock, you buy it, you are investing some money into a common enterprise, which is the company. You are, as a stock owner, you have no say in running the company. So it's the investment, it's the efforts of others. And then there's a vertical and a horizontal privity. And so that means if it's vertical privity, that means that how you do is completely intertwined with how the company does, which, you know, using IBM as an example, if IBM stock goes up, then your value goes up. And then it's got horizontal privity in that if what is good for you also happens to your fellow investors. So again, if the IBM stock goes up, everybody's stock goes up. So that's, and the Howey test can be satisfied with either vertical or horizontal privity, and that's important, but for reasons that we don't need to get into right now. But the use of, I mean, no one, even in the legal community, unless you were a securities lawyer, no one really talked about the Howey test 2 years ago, 3 years ago. But with the advent of ICOs, it became a buzzword on the internet, especially in the crypto circles, and it is the #1 thing that I have to discuss with clients when I talk ICO or STO or IEO or RICO. You know, it's all going to come down to analysis of Howey.
So what are the implications of tokens being considered a security then? in the US at least, or, Thailand.
Yeah, well, yeah, I mean, I have a very limited view on this, but if so, one of the major benefits of having a tokenized share or company or token is transferability. It's very easy to transfer these around, right? But if it's deemed a security, then you can only sell these through an authorized broker dealer in the US. So that would restrict its liquidity to these exchanges that have that license would be the biggest thing from my standpoint. But I can let the lawyers help me out on that one.
So I guess on the international side of things, we've seen a lot of different countries basically pushing forward regulatory frameworks, defining what a token is, what its security is, what a utility is, furthermore, kind of things like kind of loyalty tokens, which are kind of the bare bones ones would usually don't fall within kind of security side of things. Utility tokens can have certain aspects of it that may make it a security, may not make it a security, versus a security token, which is basically a representation of an investment. So there is an expectation of profits, or it's basically backed up with something that's tangible. So, taking into account all these kind of different things that are happening within the world, the US took their kind of view from Howie and applied it to, what could this actually be? Other countries basically have taken their time in developing frameworks, such as the Monetary Authority in Singapore back in October or November, published their guidelines around, what crypto regulation is and basically, what the licensing regime looks like. Across my desk over this morning, Cayman Islands basically finally published a virtual asset bill that was 29th of this month, so 2 days old now, or 1 day old, depending what part of the world you're in. And so they're basically kind of pushing these frameworks to get forward to, bring it within a regulatory framework so people can have certainty on doing an offering. And like in the early days of ICOs back in 2017 and earlier, there was a lot of uncertainty. It's like, does it fall within the regulatory framework? If so, does this apply? Does it not apply? So regulators have been in a position where they're taking a look. It's like, all right, is this basically a blatant security, or have they tried to do it in such a way where they're trying to use best practices and make it in a way that kind of makes sense to, launch a proper utility token. The ones that we're seeing basically in front of the SEC at the moment are the ones that were a little bit early, that had certain components of their platforms, which the industry basically kind of decided, yeah, that does make it a security, and there was a pivot away from those. But some of these early fundraisings are the ones that are getting caught up in those kind of cases at the moment. So.
Hey, and you talked a lot about defining these tokens and defining them, and I'm just wondering what some of the criteria or case law that governments use to define these tokens or these coins.
So I don't think there is much case law because it is so new. So we've been looking at the SEC basically for some of their cease and desist orders. So one of the first ones back kind of 2.5 years ago was like the Munchie case, which was one of the early kind of cease and desists. And then we started having guidelines coming out of, how the SEC would actually kind of deal with these. Same thing in Singapore. There was a couple kind of discussion papers and kind of guidance papers put out by the Monetary Authority of Singapore, which gave us some guidance. And then regulators started putting, kind of digital asset acts, virtual asset service provider acts like they have in Malta, the Estonian frameworks, Cayman Islands, Bahamas, Thailand has its own as well. So all these different kind of jurisdictions started kind of putting their frameworks together. And it's not really kind of based on previous stuff, but it's all brand new. And there hasn't been a lot of enforcement proceedings on these acts yet because it is new. And what we also kind of found is a lot of times the the assets of like Malta, for example, they brought out all this new legislation trying to create a basically entire industry around the kind of the crypto island concept that they were developing. The unfortunate part, what happened is went into a bit of a bear market, and crypto became a bit blasé and not popular, and it did not gain the traction from the industry that it probably could have had. Just about a year too late, essentially.
Great. Yeah, I've heard a lot about this Telegram case, and I know that it's considered to be pretty monumental. Dave, you smirked there. Do you have something to say about this? What are the implications of this case?
Yeah, Telegram case is unfortunate. But I basically, the way I read it, first of all, it's on appeal right now. Ben told me before the start of that they might be giving some money back. But reading through the fact pattern, if they really did, if they had sat down and thought about what the U.S. securities laws actually say, they couldn't have done a worse job, in my opinion. You know, they tried to break it up into a two-step transaction. So there are exemptions to the securities laws. And the most common one is called Regulation D 506, and 506C is what they were using. Basically, it says if you sell to an accredited investor, you don't have to go through the registration process, which is, you know, $100 million probably for most IPOs. I mean IPOs in this case, because that's what this traditionally refers to. So anything that's a security that you can sell to an accredited investor, you can get this exemption. And there's a couple other ones. So they claim that these accredited investors bought the right to buy the grams, as they're called, when they would be released on the Telegram net. So that in itself is an investment contract. That is security. Both parties stipulated to the fact that that was a security. Where the dispute came is the fact that they didn't take delivery until the network started, and that the grams are supposed to be consumable and would be a commodity. You know, the CFTC has said that Bitcoin and Ethereum are commodities at this point, but they're completely different than an ICO. They were done in completely different ways. And they've been around long enough, and the network effect has basically deemed them to be currency or commodity, how you want to look at it. But so the argument was that because they were going to get these investors, 175 investors were going to get the grams at the time the network started and the public could buy, then it's just like having currency. But the problem is they basically what they did is they turned these 175 people into underwriters. And in the real world, underwriters are your JP Morgans, your Goldman Sachs, your Citibank, your Bank of America, all your investment banks. What they do is they take a company that's going to go public and they syndicate it. They syndicate the offering, and they basically pay a price for the shares, and they sell them in the secondary market on the day that they get listed. And so they make that spread, and they're out a lot of times. I'm very much simplifying this, but SEC basically said that's what they were doing with these VC funds and these private equity guys that bought, you know, $1.7 billion worth of grams, and they got them. They were the first tranche. They got them at 33 cents, and they had to hold them for X amount of months. And they're the second tranche. They got them for like $1 something. And then the Telegram said the floor price was $3.49 upon selling. So that right there is clearly an example of, without using the actual words of syndicate, underwriter, etc., securities offering, that's what just happened. And then there's all sorts of other stuff that if you really didn't, they wanted to make the argument that the value of the grams were not going to be based on the efforts of Telegram, then the idea that they were going to hold grams back for Telegram and for its founders, and those holdbacks were the most valuable thing that the company had. Then and there's even emails about in the discovery about from founders and from investors saying, you know, we want you to have these grams because it aligns our interests. That completely invalidates the argument that they're not going to be involved in the value generation proposition. So the Telegram decision, to sum it all up, in my opinion, Jason, I'm sure you've got one too. The Telegram decision definitely has a chilling effect on the market. It is as it is lagging. All lawsuits are going to be lagging. So as Ben said, what happened 2 years ago, and that's when this happened, is not the same as it is now. But I think it will have a chilling effect, but it also serves as a roadmap of what not to do when you create. If you want to go that route, you still want to attempt it, just take everything that's in the Telegram complaint and do the opposite of it. And I'm not going to say you'll be successful, but you'll have a damn better shot than Telegram did.
Awesome. Ben, is that what you did when you worked to conduct an ICO?
Do the opposite of Telegram. I think we were probably before Telegram. I'm not sure when their actual one was.
Okay.
Yeah, but like Dave said, I mean, it's at that time there was very little information out there. So it was always kind of feeling around in the dark and being as careful as we can and as strict as we can with certain things, but operating with as much good information as we had at the time, for sure.
Yeah, on that note, are there any specific or special considerations that you take when entering this kind of new regulatory landscape? And this can be a question for anybody. Maybe the lawyers can talk a little bit about how you approach advising clients on launching an ICO as well.
Launching an ICO, we don't really do ICOs anymore. It's basically they're become something kind of the past. The idea of having kind of crowdfunded cryptocurrency for a project, it's not really happening anymore. There's been a couple clients we've had over the last 2 years, which have tried after kind of a little bit late to the market, and it just hasn't been successful. So if you look at kind of the more traditional kind of ICO style, it's not happening. I'll use an example here in Thailand. So they created a regulatory framework, and it was basically one of the first ones globally and the first in Southeast Asia, where they actually developed 4 different types of crypto licenses. So they basically developed an exchange license, a broker license, dealer license, and then something called an ICO portal license. Now this license for the portals was enabling a company to come in a regulated environment and help a company do an ICO. We were basically, one of my kind of companies was basically in the process of obtaining one. Crypto winter hit. There was a couple other applications that were going through. I believe 2 or 3 licenses have been granted so far. Nobody's done a deal. It's just a bit kind of, it's not happening in the way that it was kind of designed. The way that this framework was kind of intended mirrors that of like what they call like an IEO, like initial exchange offering, where you have like a third-party exchange working with the company to do so. There was a bit of some positivity in the market around IEOs a couple of years ago, but they never did raise the numbers that ICOs did, and the majority of them kind of basically fell on their face and kind of flopped at the end of the day. So when it comes to kind of crypto projects now, our advices have definitely changed and pivoted. The ones that we see are more kind of around loyalty. So it's like rewarding people out of a platform for doing certain things. With loyalty programs for traditional companies, and just basically tokenizing that side of it, where you can have kind of more instant liquidity and have it as a exchange the points more readily than through kind of centralized platforms. So that kind of stuff we're kind of seeing in the background. But as far as ICOs, it's been 12 months since we really kind of discussed one.
Interesting. We'll switch gears here, and Ben, I have a question for you. I want to talk a little bit about decentralized finance. Can you just give us a brief overview of what that is and what the ecosystem looks like today?
Sure. Overview on what it is. So decentralized finance, DeFi, is just the idea of taking these decentralized networks, these to change the old financial products that exist into a more like decentralized nature, so trustless, transparent, all of the benefits that come from being on a blockchain. So, but the biggest one of these things operating without a central authority or some intermediary. So that's kind of what it is. And then the update on where we are now. So DeFi has been growing in popularity lately. It's been kind of the buzzword. And I guess where we are, I would say it's the new and shiny object. So it's still very much a move fast and break things mentality. There's a lot of innovation and a lot of really, really interesting things popping up that aren't quite battle tested yet. But the majority of it's, lending and borrowing would be kind of the core of what is happening most within DeFi. So MakerDAO would be like the oldest one where you can, it's amazing. It's so incredible. You literally can lock up an asset, say Ethereum, and pull out a loan that's backed by that Ethereum in a stable coin, and then you haven't even touched that Ether and you have fresh stable coin that you can spend on whatever you'd like. And it happens in a few clicks. Like try to use your house as collateral and get a loan that you can spend in a few minutes, or use anything as collateral, right? It's pretty amazing.
So those are some of the benefits. What are some drawbacks?
Well, I think, first of all, I want to preface this by saying that I'm absolutely a DeFi fanatic. So if I say this to my candidate clients all the time, if I sound negative, just because I'm a lawyer and I have to talk that way. But the drawbacks are kind of some of the benefits that Ben just listed. Move fast and break things. Not knowing what the regulations are. You can get in trouble if you break some of these things. Anti-money laundering laws are real, and they can. All the acronyms are very scary. FinCEN, IRS, AML, KYC. They mean things, and they're scary for a reason. But at the same time, it's so cool. I'll say from a technical standpoint, there's been some really shady stuff that's happened, and it's been glitches in code and like unforeseen issues that really smart and unethical people like hackers have been able to exploit. And the biggest one that I know of was the Flash. What was it called? Like the Flash, the scam or whatever it was, where the guy he made $12 million in
all within one block. It was a flash loan, I think, right?
The Flash loan, yeah. And someone that Ben and I both know drew out in a diagram of how it happened, and I stared at it for like 30 minutes, and I still can't wrap my head around it. But at the end of the day, this guy sort of loaned something within, what's an Ethereum block, like 3 minutes now, 5 minutes, something like that. He loaned something, and through a series of machinations, got something back way more than what he should have gotten, all in one transaction. And somehow, like, no one really lost money, but he ended up with a ton of money. It still blows my mind. That's the drawback, is you've got crazy shit like that.
Yeah. But without this innovation and this like sandbox to play in, you wouldn't get all of these benefits. So it's this new potential global financial system that's completely inclusive. It's trustless, it's instant, it's transparent. But yeah, it's very much a let's reinvent everything, even if we don't fully understand it, and do it pretty quickly. And these things, like, there's alpha versions that spin up with millions of dollars of volume in the first couple days, and you're like, this is an alpha, like this is people's real hard-earned cash, right?
It's insane. It's amazing how quickly it adopted. I can't tell if it's a bad thing or a good thing, how quickly it's been able to mirror financial products that have existed.
Well, and I will say that, like, traction and being used, it's very much a tiny little playground of people using these products. And Dave, you and I are some of them, right? It's the people that are like, hey, you can take a loan out here at 1% and lend it there at 2%, and I'm making 1% risk free, except for this is a new platform, that's a new platform. You haven't you're now a coder, so you haven't audited either of them, right? And it's held in some crazy stable coin that you have risk layered on risk, but it appears riskless. So yeah, it's poised for more adoption, but right now it's definitely just people kind of playing around with it.
I will say the size could be logarithmic. I mean, at the end of 2019, there was roughly $4 billion worth of stablecoin transactions or market cap, I should say. And as of now, it's over 8. It's catching on quickly.
I think that's a bit of a misnomer, though. When you look at, I actually have it in front of me. When you look at something like USDT, it's 6.39 billion in market cap, but its 24-hour volume is 88 billion. So it's being cycled so many times per day.
It's true.
It's just being used so much. It's really kind of interesting how it's able to sit there. And I think one of the problems they do have is when you do have these kind of really crazy days when people want to go to more of a safe haven, is the supply of these stable coins becomes an issue, which does cause some kind of price fluctuations within itself.
Yeah.
Kind of speaking of that, when we had, it was about 2 months ago, 6 weeks ago, when we had this kind of big drop in the price of crypto, it was the 47% one day, whatever it was. I was basically kind of positive a lot of these kind of DeFi projects would explode at that point.
Yeah, me too.
But apparently, a lot of them kind of weathered the storm in a kind of a good fashion. Some kind of did blow up. Some are still okay. And it kind of goes to the kind of the showing, just like putting some kind of code in the background and have proper stop losses and design the system smart enough and enable it to kind of work through these kind of unprecedented times. It does work.
Great. So I have a question just about the regulatory structure. What are you guys' thoughts on implementing a worldwide regulatory structure? Is something like that even possible?
No, you can't have a worldwide structure because there's not a worldwide government. Now, you can say that what the U.S. does kind of sets the standard for a lot of people, and I'm not a proponent of that. I'm just saying that's kind of the reality. But I think the whole point, I mean, they're going to get you at the off-ramps and on-ramps. We're going into and out of regular currency, and more so for crypto. My thought is that if you stay in the DeFi world, at least for now, it is mostly unregulated. I'm not sure that it's super regulatable. Maybe in more draconian states like China and perhaps Russia, but in democracies, I think it's going to be difficult to regulate the DeFi stablecoin type thing. Some of the cool DeFi products like the futures tokens that represent a 3x move on an exchange that can be moved and used as payment. That also, first of all, is incredibly cool. But second of all, that might be easier to regulate because it's more of a financial product. And these things all would be, but getting back to stablecoins, these things all would be subject to the rules around money. I'm just not sure from a technical standpoint how, and this is not an advice to break the law, I'm just not sure from a technical standpoint how that kind of regulation gets implemented.
So I think we have seen some initiatives globally in an attempt to regulate things like FATF, the Financial Action Task Force. They basically came up with a series of recommendations last year around money laundering in crypto. And one of their kind of most contentious things is something called the travel rule, which is a packet of information that goes with a transaction that's either over €1,000 or $1,000, which basically enables the identification of who and to and from that crypto is going to. So the industry for the last kind of 9 months essentially has been kind of in a state of flux, trying to figure out how to deal with this. what kind of technology we use, what is the basis of how we're going to communicate with each other. So different industry groups have been working together trying to figure out how to actually kind of do this and put it together to actually make it work. So things like that, the US will kind of naturally adopt as kind of standard practice because they can't do it on their own. So they need kind of a global regulatory framework to do so. And FATF is in a kind of an interesting kind of spot to do so.
And I will say, just to build on that sort of, I got to backtrack a little bit because you have CRS that was adopted pretty much universally, but it took a long time and it's still not universal. And the way that it got adopted was after the Patriot Act, the United States leaned on everybody very, very hard. And we can do that right now because the dollar is the reserve currency of the world. And also we have the biggest and strongest military, well, the strongest military presence, whatever. Really, it's the economic thing. It's the fact that everything is denominated in dollars and that we control SWIFT. I think that the potential I think that our buying power as far as being able to enforce those de facto worldwide regulations, it goes down as our economy implodes, which I think it's going to implode. But that is just my opinion.
Yeah, I think the one to watch right now is going to be China. There's some really interesting stuff happening there. So they're basically doing a test run for their national digital run state currency. So China's always been an interesting one where you've had Tencent and Alibaba had Alipay and WeChat Pay, which are two mobile phone-based applications for the people that may be not familiar with it. Which is basically you add money to your WeChat account, you have a QR code, you can scan it, you can send people money. Works rather well. It's the adoption in China is just incredible. Basically the fact that people stopped using cash. I've had instances when I showed up in China, couldn't find the ATM machine because they took them all out because nobody uses them anymore. So it's an interesting one, but what the state wants to do is actually kind of have their own kind of digital cryptocurrency, and they're able to kind of regulate it in such a way and then ping that to the RMB. So it's kind of an interesting one. And then also kind of read some news out of China yesterday that they're going to kind of decontinue some US dollar pegs on the stock markets, which is going to have kind of a massive influx and difference on RMB USD trading. So I think the US dollar is becoming less important in the context in kind of Southeast Asia.
Well, I mean, they have a real incentive to stop relying on the US dollar. It's a global reserve currency. We have so much power as Americans.
Yeah, absolutely.
And you're talking a lot about currency here, so I'm wondering if there's a place for these payment type coins alongside investment coins. Is there a place for both? Is one hindering the investment one hindering the ability for payment coins, stable coins to take off?
I think they're complementary.
Yeah, I mean, for stable coins are needed because people don't want an asset class or want to pay with something that's fluctuating wildly. Yep. So a good example of like this 2-token system would be MakerDAO, where one is more of the speculative governance token, and then one is the stable token that you can use as a medium of exchange. So these things are all, I mean, the whole space, right, is a giant experiment. But yeah, I think they can be complementary for sure. Each one serves a different purpose.
Yeah, I think the challenge when you look at the business models of what are essentially kind of private stablecoins. So stablecoins run by a corporation or organization versus something that's more more decentralized or run by kind of a central regulator or a reserve bank. I think the problem they're going to have going forward is the era of low interest rates and negative interest rates. because the way that these companies make money is having deposits and then be able to generate some interest on that. So if you have a stable coin that's banked 1-for-1 and $1 billion in the bank, there's kind of the assumption you would be able to earn some interest on that $1 billion as it sits there and actually pay for the expenses in actually running that that network. Seeing interest rates falling, seeing U.S. bonds go to kind of lowest in years, negative interest rates in Europe. It's going to be interesting to see how the business model does shift away from that. My kind of longer term thoughts, I think it's going to become more kind of reserve bank or central bank issued, because for them it makes sense. It just replaces paper money.
That's where
everything's traceable. You can inject monetary policy directly into people's wallets, right?
Absolutely.
You want people to spend, you put negative interest rates, and you can't take out money and put it in your mattress.
Yeah, I mean that's where this whole like utopian Satoshi dream goes dystopian and becomes authoritarian. If the central banks do get a ledger, and it does get it's an immutable ledger that they get to use as their basis for their currency, I think that is a very scary thing for freedom and for censorship. I think it's rife for abuse. I think China is going to be very excited to use it in that sense, but the US will be right there too.
Oh yeah, big time.
So this is a question for those of you who take clients. Because some of these cryptocurrencies do appreciate in value, do you think there are some ethical concerns there with taking or accepting crypto as a retainer or payment?
In the United States, I'll let Jason answer for Thailand and Asia. In the United States, you can accept anything as a retainer, almost anything of value. You could give me a diamond, I could put it in a safe, and it could be a retainer. But that being said, I mean, we take crypto in payments, but I think you have to be very clear in your engagement letter what you say to your clients. And what we say to our clients is, we'll take your crypto, we're going to exchange it on our firm's exchange platform. We're going to put it into our Coltaf account in US dollars, just like we would any other client. And it's going to sit there. It's not going to earn interest. This is like it doesn't earn interest for any client. And we will pay it. We will pay our fees against that. And then when you're done, if there's anything left, we can put it back in the crypto and send it to you. I have never had a client demand that they keep it in crypto. And while it wouldn't be illegal or unethical, I wouldn't do it because I pay my bills and my people in dollars. So it's always going to, until that changes, it's always going to be converted, at least at that point. So that's my thought on it for the US. But Jason, what do you think about Thailand?
I think it kind of holds true everywhere. You just basically need to deal with the asset as it's taxable and basically put a price to it. There's nowhere on your kind of financial statement you report back to your national regulator of how many Bitcoin you have. It's either dollars or euros or whatever that number is. So having an accounting system in place where you're able to basically understand what my acquisition price of that Bitcoin was, what my selling price of the Bitcoin was, any FX and exposure losses or gains across it should be accounted for. So, if you start taking crypto as payments, you need to basically understand, what the price is essentially and account for those kind of losses and gains. If you process everything kind of the same day, you can kind of net the number off and just have it as a processing fee. But if you have stuff sitting there longer term, that does kind of create exposure in the long run if there is kind of massive ups and downs. Because if you say take $10,000 in crypto and it goes up 5 times, well, you're going to have a $40,000 gain on that in addition to what your kind of normal tax payable on the original 10,000 was. So you just have to be really kind of cognizant of the accounting issues and record keeping around it. And the nice thing about crypto, you can't understand exactly what the price was at a certain time, but it is kind of a pain to go back and figure it out. So, having these kind of more automated or systems where you actually kind of record the value at that date is kind of essential.
Hayden, I see we're kind of pushing time here, so I just have one more question and then I'll take some audience questions. I see we have a couple building up here. I'll direct this one at Ben. I know we talked a lot about the current landscape of cryptocurrency, but I'm just wondering specifically what has COVID-19's impact been on the DeFi and cryptocurrency world in terms of trading? You know, have there been more scams than before? Yeah, what are your thoughts?
Yeah. Well, firstly, after spending a lot of time thinking and building trading systems, I actually don't trade anymore. Um, but
Not even with, come on.
yeah, I mean, like very little compared to what I was doing, right? So in terms of like what is COVID-19's impact on crypto, I would say the more broader economical impact to financial markets have also impacted crypto. So you know, they're not immune. That that this space still has a long way to go in maturation. I think for me personally, realizing how small this space still is, like sometimes when you're in your own echo chamber, you think that the whole world's living and breathing crypto and it's so great and awesome. And then you realize there's a $2 trillion stimulus bill, and just a fraction of that could buy up all of the cryptocurrencies that exist that we have. And you realize, I mean, so for me, it was more of that, you know, I'm sitting here thinking it's the new digital gold and it's so uncorrelated, and then you kind of get the wind knocked out of your sails and you realize just in fact how small and kind of insignificant it is in the global stage. So that's not to say that I think it's insignificant and that it won't amount to being something significant, but just, you know, we still have a long way to go before mass adoption, or before this is something that everybody cares about.
I've heard, oh, go ahead.
Sorry. So I think what's happened as well is you have a lot of these kind of smaller kind of companies and projects which have been developing for the last little bit. The ones that are up and running that are properly funded, I think they'll be okay. The ones that aren't funded, I think will just kind of disappear over the next little bit. Just like in any market, it's just a massive kind of reorganization of you know, what's out there. And just like any other startups, I think it's going to affect a lot of these kind of smaller projects. They might have fantastic tech, but if they can't cover their operating personnel expenses on a month-to-month basis, it's gonna fall away. So I think there's, you know, opportunity to basically for more established kind of companies and projects that have resources to pick up really good technician, really good teams, and develop new product coming out rather quickly. But I think it's going to be a bit of a bloodbath at the smaller kind of developer and company side.
I will say I agree with both of you. I have heard some interesting thoughts about the actual physical transaction of money and the fear of COVID leading us towards a cashless and then therefore DeFi type world. I think that the argument with the cashless, that is valid. I think it's a little bit of a stretch, but on the right path for towards the DeFi world. Because you know, anything you can do to minimize contact is probably going to make people feel better.
Mm-hmm.
Well, cashless and government currencies, right? Like this whole stimulus check thing in the US, it's like, you know, some people got it a couple days, the checks are in the mail and all of this stuff. So if you have this central bank issued currency, it's just like, hey, here's your stimulus money, and it's instantly in your wallet, right? So, and it's very different from DeFi, but it has a lot of the benefits of just instant push to you whenever you need it.
And then, hey, here's our tax money, back out of your wallet.
Exactly. And hey, you don't even need to file taxes this year because everything is traced. So we see all of your transactions, and you should watch how much you spend at McDonald's because you spend a little bit too much. So the health insurance company has just upped your rate as well.
Yeah. Oh, it's fucking terrifying.
It's gonna be there, right? I mean, it's going that way.
Well,
Think all the
I
great
think
analytics.
exactly. I think that's just kind of the start of it. When you look at kind of what's actually kind of happening in kind of different AI projects and different technologies that are happening there, it's much more scary than just what decentralized finance can basically have. The amount of insights that they can make assumptions on using kind of the data points is just amazing.
Yeah, that's a whole nother webinar if we wanted to talk that sort of stuff. And
It's real dark.
I'll take a Xanax or something because I'll have a meltdown.
Yeah.
Well, on that note, we'll jump to some audience questions here. I have one that says, do any of you hold cryptocurrency and do any of you hold stable coins? I think that, yeah, we could just do a show of hands. I think that you have.
I think you go with the Edward Snowden response, right? If I had crypto, I wouldn't tell you.
Yeah, something like that.
All right, so for the lawyers in the group, do you accept crypto? Oh, we answered that one. As payment for legal services? Yes, we've had that one answered. So what are the biggest roadblocks to mass adoption of cryptocurrency?
Education, regulation.
Agree.
This one is specifically for Dave. What are your thoughts on RICOs?
RICOs are nonsense. They would have been a cool idea at the time. All they really seem to be is a fancy smart contract version of the lockup with incentives of when early investors can get out. It doesn't get people think that it's going to get past regulators better because it safeguards people's money better. It doesn't. Maybe it does a little bit, but ultimately it's still a security. It's still going to be sold as an unregistered security. You're still going to have the same problems, and I don't think it's something that really gets the industry interested in ICOs again. I just don't.
What does R stand for with that?
Reversible.
Reverse.
I haven't even heard of those. I was thinking DICO or CSO. Like I'm familiar with the concepts.
Yeah. Last week we actually reviewed one from a firm that was actually trying to do one, and trying to get our heads around it, and it was just really kind of complex how they actually kind of tried putting the framework together for it, and at the end of the day, it made no sense.
Yeah, that's been my take on it.
Just another dumb idea. That's all it is.
If you could change one regulation related to crypto and or DeFi, what would it be? That's a fair question.
Is it just one?
Yes, just one. Choose wisely.
I personally, it wouldn't necessarily be limited. It wouldn't necessarily be just limited to crypto. My number one change would be to get rid of the accredited investor rule and allow people to make their own decisions on investing, and maybe not get rid of it all the way, but change it. It's not fair that the average person, the rules were put in place for a reason, and it was the rampant abuse in the 1920s and that led to the depression in the 1930s, hence the Securities Act of 1933 and the Exchange Act of 1934. They were a response to something bad that happened, and that was, grandmas getting suckered into investment schemes that were nonsense, and that's what they're meant to protect people for. But with the amount of technology we have and the amount of information that is now available, the fact that only rich people can participate in early stage ventures and makes them richer, and people are held out as being incompetent because they're not wealthy enough, I think that metric needs to change. I think there's a better metric. I think that there are plenty of people who don't have the $200,000 a year salary that are more qualified to make those investments than people who do. I think it's an archaic and unfair way of limiting the investor class, and that's what I would change, and it would have an impact on crypto as well as all other assets.
Yeah, I definitely agree, Dave. I'll put it in a bit different context, I think, as well. So I think we've seen some kind of relaxing and kind of regulations around kind of equity crowdfunding, where you have certain countries around the world that have basically given exemptions for people that don't fall within that accredited investor category, but they're allowed to basically have a limit per year or per transaction that they can actually invest into these kind of higher risk things. So I think New Zealand had something similar. Off the top of my head, I think it was like $15,000 annual was kind of the limit towards it, with no transaction being over $1,500 or $1,000. So I kind of compare it to like a night at the casino. You can take $1,000 on a Friday night, you know, go out, throw some money down on a table and have a gamble. It's essentially what it is, you know, except instead of going to the casino, the guy's sitting home with a bottle of wine in front of his computer, investing in kind of, you know, interesting things that they find online.
A whole bottle?
A whole bottle, maybe two. And so if you have kind of a relaxation of a kind of universal relaxation, basically for up to a certain amount, you're still protecting the grandmothers and the taxi drivers that basically are trying to put their entire life savings into something that, you know, $10,000 isn't going to wreck most people, but 100,000, 150,000 would if they get kind of hooked on it or dealing with kind of unscrupulous people.
The very nuanced, much more nuanced way of putting it, as usual, Jason. Thank you.
Ben, any thoughts?
Those are good ones. One that I liked was like the proposed bill of anything less than $600 purchased with crypto, not having to worry about reporting. So since it's treated like an asset in the US, every time you transact, you have to calculate your capital gains, which can be very arduous if you're buying a $3 cup of coffee sort of thing. So it kind of kicks the legs out of it ever being used as a medium of exchange day to day. So I think having some sort of rule that would make sense and make that easier would be a great win for the space in general.
Mm-hmm.
Awesome. Well, that looks like all of the questions that we have for today. Thank you to our panelists, Dave, Ben, and Dr. Corbett, for this insightful, enlightening panel discussion. Thanks to all of our audience members for your great questions. If you have any other questions, feel free to email us, and be on the lookout for more webinar panels and presentations just like this. You can find them on our website, on our social media channels, and I think we're going to put up the disclaimer just one more time here. And yeah, everybody be safe. Take a second to read the disclaimer, and we'll see you next time. Thanks.
Thank you.
Thank you, everybody. Thank you, Rebecca, for putting this on. Thank you, Ben,
Thanks.
and thank you, Jason, for joining it.
Thank you, guys.